So really happy to be joined here with Ben and Jed today, two professional, very experienced angel investors on stage today. Before we jump right in, why don't we have the both of you give a brief introduction of your backgrounds? Why don't, Jed, you start?
Sure. Thanks for organizing and moderating, Jowell. Hi, everyone. My name is Jed Ng. I'm a tech venture builder. I built two new technology businesses in the last 5 years on two different continents. My current journey has been building and running the world's largest API marketplace in partnership with an Andreessen Horowitz-backed company. I'm also an advisor to Turing.com, where I co-invested alongside angels like Cyan Bannister. And I'm also a syndicate organizer where I raise, $250,000 to $500,000 checks for startups. And my last exit was a company called Voxeat last year that got acquired by Dolby Labs.
Ooh. And Ben?
Awesome. Thanks, Joel. Thanks for organizing. So like everyone else, I do a bunch of different things. I'm a professional board member, so I sit on a bunch of different boards. I'm a tech industry analyst, so I've been sort of an analyst in the tech space for about 15 years. And I'm an angel investor. I've done probably 40 or 50 deals over the past 10 years, I guess, and had, 8 or 10 exits, thereabouts. And I also run a few businesses here in New Zealand. So I own the largest apparel company in New Zealand, and do a bunch of different things.
Cool. Okay, so a lot of people are very interested to know. Angel investing is it seems like it's very unclear how you can actually get into being an angel investor. So would you guys share what was your journey into getting into angel investing? How did you start? Ben, you can start first.
Yeah, so as I said, I've spent about 15 years primarily working in the Valley and as a tech analyst. And I always got kind of bored talking about all of these cool tech companies and watching them go from startup through to eventual exit, because just talking about them isn't the same as actually being involved in the ride. And so about 10 years ago, I was invited to invest my first ever angel deal, and it was just kind of a logical thing to do, right? Because it's just watching progress is one thing, but actually being a part of progress and being a part of the excitement and all that stuff is a super cool thing to be involved with. So in some ways it's the easiest thing to get involved in, because all you do is write a check. But in some ways it's the hardest, because where do you start? How do you take that first step?
I think for me, if I look back about 5 or 7 years, I had been running an investment strategy that had been generating 10 or 12% for me annually on a passive basis. And I was kind of looking for a way to beat that and generate like outsized financial returns. The first thing I turned to, the obvious one, was like public markets. And, if you look at just broad averages, it's just the amount of effort required and the risk reward profile. I didn't think it could be consistently done. And that's kind of why I turned to angel investing. I think it's an asset class where investors can systematically play for multiples return, like what Ben says, right? If he's got a 20% exit rate on his investments, that those numbers says something. And I think beyond that, angel investing is incredibly interesting because it's also about channeling capital to efficient use. And also getting a great source of learnings as generating other sources of value.
Right. Yeah. So a lot of people who wanted to get into investments, they didn't know where to start, and angel investing could be a way where you can start off with a little less capital and a little less knowledge, depending on whether you want to be actively managing it or not. So it's a good way to start, and it's great to hear your journey into angel investing. What would you what types of investment do you guys do? Like, what are the verticals and what geography do you invest into? And you can start.
Yeah, Jed.
Sure. So for me, my focus area is primarily around software, deep tech, B2B, and anything on APIs. I'm very interested in because of the nature of my work. I mainly focus on the seed to Series A stage on US companies primarily, if not Silicon Valley. The other things I screen for are around looking for exceptional founders and businesses that fit into some mega trends or shifts that I perceive.
Yeah, I mean, stage is the easy one to answer. I'm the same as Jed, kind of seed to Series A. Geography is, so I've done deals in the US, in the UK, in Australia, in New Zealand, all around the place. So geography isn't a barrier for me. In verticals, I mean, I've done SaaS, I've done deep tech, infrastructure, B2B, a little bit of B2C. So really, I don't have a thesis. It really comes down to what Jed touched on, which is exceptional teams and exceptional founders, and that trumps everything else.
Right. So with the technology we have right now, it's geography is no longer a barrier to investment, basically. Well, for Jed, I have a question for you. You invest globally and locally as well. So a lot of people who want to get into angel investing would like to know, how do you find all these startups? Like, where is your source of deal flow, both locally and globally?
Sure. I think for me, I was quite fortunate early on to develop a sharp focus on how I was going to invest. I always thought, be focused and I can gradually expand from there. And primarily for investors, right, it's really important, I think, to define your the geography, domain, and stage that you want to invest in, and why that is. Today, despite technology and everything, it's kind of this weird things, right? We invest in companies that are that can see through walls or flying cars or sending things to Mars, and yet early stage capital is still highly local by far, right? Which basically means, I think, that as an investor, you need to build deep local networks that support your thesis. And that's not always easy because it requires a fair bit amount of effort, and even with that, it takes time. I'm personally a big advocate for working with syndicates, because I think syndicates are a good way to penetrate these networks. They also lower the investment minimums for investors, right? So you can start with $1,000 or $2,000, and even if you lose it all, it doesn't really hurt you that much. And this can be a way to learn from the experience, even if you haven't honed in on your thesis, without it costing you too much. I always reference Jason Calacanis, in his book Angel. He has this great strategy of using syndicates as kind of a cheap way to learn and build your own network of investors so that you get to your own deal flow. And I also think it's a great source of efficiencies, right? You're basically able to invest alongside somebody whose vision that you trust in. You're able to keep the quality of the investments high versus the amount of effort you need to invest. And you're giving up a slice of the profits for being part of this syndicate, but generally the incentives are pretty well aligned.
Oh, yeah, that makes sense. I mean, especially if you've just started off as an angel investor, you kind of are just testing waters, and you don't have a lot of experience yet. So joining syndicates, even if you fail in certain deals, it's still a small fee to pay for the learning and the experience you get to invest with other more experienced more experienced angels, and also you get to learn like from the experience, and you also get to build your network in the local market. So
Yeah, absolutely. And I think just one more comment is around like today we have all these great like platforms and digital tools that make things so much more accessible, right? Even before COVID, a lot of accelerators and incubators were running demo days online, and you can see pitch decks, and they're just all over the place, and that's a great way to learn. It just makes it so accessible to find, to hone your thinking and to find other people to invest with.
right. But so a lot of people would say, although you can access deal flow globally, in order to be a good angel investor or investor in general, you have to have deep knowledge in the market that you're investing in geographically. How would you comment on that?
Oh, is that for me or Ben?
Jen, for
Oh, for
you.
me? Yeah. Um, so I'm in two minds about that. I mean, because part of I think this experience of angel investing is also about learning and broadening your horizons. I think a lot of people tend to invest at the start around their comfort zone, or they largely stay within their comfort zone, which isn't necessarily wrong, but you're probably not, betting for the big multiples return, right? Because you in the end tend to play like safe, right? So having a geographic lens makes sense. Having a domain sense also makes sense. I think that for starting investors, you do want to like kind of balance that out, right? Because if you are over invested in a certain geography and in domains that you're familiar and working with, you're probably like being over leveraged. It's like, working in the telco sector, but only buying telco stocks. It doesn't help you diversify.
Mm-hmm. Yeah. So if you have the ability to invest in markets that you're comfortable and you have access to, it's a good strategy to diversify your risk in investment, and also don't put your eggs in one basket. So if you have the network, especially if a good way to start, you mentioned, is joining syndicates to penetrate into market as a first step into investing in a certain market, to learn more about the market and the investment scene there. That's a good way to start as well. Okay, I have a question for Ben. So you have been quite a rebel, I would say. A lot of people would be saying are all about growth hacking, are all about hyper growth in startups. But you have a theory that is called the anti-thesis of growth hacking. Would you care to share more about on that?
Yeah, so I mean, I'm all for growth. Don't get me wrong, but I think what coronavirus has shown us is that there's been a lot of people that were doing stuff in the name of growth hacking that didn't actually achieve anything. And when there's a bunch of capital going around, and when it's easy to raise, and when things are really bubbly, people will spend money, people will buy, really with no valid reason. And then when coronavirus hits, all of a sudden people say, "Oh, I need this. Do I need this? Do I not need this?" And so for me, I think what I've seen in the past couple months, I've seen lots of startups who have been so focused on this idea of hacking a pivot that they'll have these ideas in areas that they have zero kind of knowledge, domain expertise about. and they'll think that they can growth hack their way into a business in another area. And so I'm really all about, I'm fine with growth. I'm fine with hacking, your way to growth, but that has to actually be real. And I think that what we've seen, and we've only just seen the start of it, really. Coronavirus has been 3 months, but we haven't really seen the impacts yet. But what we're going to see is we're going to see a bunch of companies that have growth hacked their way to prominence through with no real validity that will fold, because people, whether it's investors or the most important decision makers, who are the actual consumers, be they B2B or B2C, will say, actually, this proposition isn't important. It's I'm not gonna waste my time or money on it. So I think that it's really important. That's the one piece of advice that I have, for the companies that I'm on the board of or that I'm an advisor to. They're looking at the coronavirus. They're trying to work out what happens to their runway, how they raise, what they do in terms of pivoting. All that stuff is good, but you need to take a really realistic lens. Look at what you're doing through a really realistic lens, given the situation that we're now in.
Makes sense. Growth hacking is not, I mean, you're all about growth, but it's not only about hacking growth, but also about building a solid basic fundamental and planning your way, building solid fundamentals and planning your financials and your business plan, rather than solely focusing on hacking your growth.
Yeah, and I mean, you go on LinkedIn and my LinkedIn feed, 90% of it is people who think they have the formula, or trying to sell people the formula. They're consultants with the growth hack marketing formula. It's like, there isn't a formula. It actually takes hard work, and it takes connection with your customers. And I know that's not cool and sexy, and it's way sexier to be $1 billion business with no effort, but that doesn't happen.
It's just like dieting, right? There's so many articles about how you can lose 10 pounds in a week. But that's not sustainable. It's a healthy diet. It's changing your lifestyle bit by bit. It's something like that, right?
Totally.
Right. Okay, so you have been co-investing with Techstars co-founder Brett Feld into Cloudability, which has successfully exited. So that's pretty big. A lot of people would beg the question, how did you find about the deal? Can you tell us more about the deal and your journey with Cloudability? Yeah,
so to be honest, I was in Cloudability before Brad was, so that's my little claim to fame. But so I do a bunch of different things, and one of the things I do is in the past I've run conferences, and I was running a conference in Silicon Valley called Cloudbeat. This is going back 10 years. And one of the companies that was pitching there, like all conferences have the pitching session for new startups. And one of the companies that was pitching was literally 3 guys with an idea, didn't have a product, and it was Cloudability. And I actually judged the startup competition, and I was only one of the judges. They didn't win, but I think they should have won. But I was really impressed with what they were doing. I was really impressed with the team, and I thought they were solving a very real problem. And so I started talking to them. I came on board as an advisor, and I invested. I was the first angel in Cloudability, and it was really an interesting process. I mean, it was my first ever angel deal, so I didn't have a clue. I didn't know what a convertible note was. I didn't know what to look for. I was totally green, and made some mistakes, but that's fine. It's like Jed said, it's about learning. And then we went through Cloudability, did a Series A with Foundry, did a Series B, and then had an exit. Really interesting. That was probably a 7, maybe 8 year progression. It went from 3 co-founders to 2. One of the co-founders his wife had baby twins the same week that the company was formed, and just looking at that time, And that's when I say, like everyone wants to be $1 billion company overnight, but it was a lot of work. And obviously I was on the outside. I wasn't an employee or anything, but you get the inside story when you're an investor, and a lot of work and a lot of heartbreak and a lot of sleepless nights. And the other thing that's really interesting with the exit side of things is that you never know it's going to work until the check hits the bank. You can be on the same day, you can think you're going to go broke, and you can think you're going to have an exit, and you never know. So people say, oh, startups are hard. You do 6 months and then you're okay. You're never okay, because the whole thing with our game is that you spend money fast. You need to get some more funding. You don't know if that's going to happen. You don't know if you're going to get your exit. I mean, it's a big unknown. So it's a huge roller coaster. It's super exciting, but it's a huge roller coaster. And it was cool. I mean, I've known Brad for a long time, because we're involved in similar things and different things. And it was cool having them invest in Cloudability, because I'm a big fan of Foundry Group. I think they're a really cool VC fund. They're good guys. I like their ethics and stuff. So it was really cool that they got into Cloudability. And Brad's a runner as well. I'm a runner. He's a good guy, and he does a lot for the community. What I really like about Brad is that he's a really successful investor, but the amount of work he does, and he founded Techstars. He obviously writes all his books around different subjects for startups and growth companies, and it was cool being involved with him alongside that.
So what is for everyone's reference, what does Cloudability do?
Sure. So kind of the thesis is, right, with cloud computing, if you think back 10 years when Amazon Web Services first started, all these people were signing up to using cloud infrastructure. But it's really easy to sort of spin up a server here, spin up a server there, spin up a server somewhere else. And you don't actually know how much money you're spending. You don't know how many servers you've got spun up, because they're just kind of out there in the cloud. And so Cloudability is cloud spend management. So if you're a large enterprise, you might have tens of thousands of servers, of which probably quite a few aren't actually needed. So Cloudability is all about analyzing that, giving visibility, making sure that your billing is correct, all of that sort of stuff. Sounds super boring, but most of those enterprise things do sound super boring, but they're super important.
Not the most successful startups aren't necessarily the sexiest ideas. It's it might be a very dull sounding idea, but it's the execution, and it's also the fact that it's solving a real problem.
Sure.
Right. So I have a question for Jed. I know that you've developed Rapid API for Rakuten. It's the world's largest API marketplace. And obviously, you have been working on designing a good UI and delivering the best UX, and you have the experience of building a good user platform. So what would be a good user platform to you, and how can investors see the team's ability to deliver the best UX?
Yeah, so I mean, I think if I bring this question together, right, it really comes down to this idea of like value, not just for investors, but also for users. Now, when I started this, when I was initially ideating on an idea play for the API economy, what that was, to be honest, I had very little idea. In the end, I settled on this concept of an aggregation platform, and it made a lot of sense for me for a few reasons, right? The first one is that on the supply side, we know that API providers are highly fragmented, right? So even today, most API providers, they provide one or a few services. At best, you see like these walled garden approaches, right? Where like Microsoft Azure, Google Cloud, and Amazon, their API service stack is like 80% the same. And there's a huge long tail out there. The other part of the equation is that for users, developers, they face a ton of friction in the whole user journey. And this friction is what prevents transactions from being consummated. And this pain, it spans everywhere from like account creation to separate logins, pretty poor tooling, key management, and unclear pricing. Right. So again, going back to this idea of like utility or value to users, right? In this case, for developers, I think the value summarized for them is that number one, it's a single account and UI to access thousands of services in a self-serve manner, which is the way they prefer to consume service. The second was to develop, best-in-class tooling, which solves things like key management, on-the-spot testing, and code generation. We were deliberately clear and consistent with pricing structures, and we've also negotiated for pricing parity with API providers. So for developers, you get all of this convenience value, and it doesn't cost you a dime more. I think what made us really successful is that we were able to drive a positive network effect in the business. So we had a critical mass of users, like a million users around the world on a cloud service, which basically gives us all these data points to iterate, test new features, roll out things to users with confidence that it delivers further value, which strengthens the platform. I think the other part of it is of the equation, if you look at it from an investor's perspective, is about defensibility. There's this great interview that Mark Andreessen did with Elad Gil, and Mark talks about this idea of like product defensibility, which is important, but ultimately is self-defeating. It's a race to the cliff, especially in software, right? The paradigm is to stay ahead in product, in UI, in UX. All of these things means consistently putting out killer features faster and better than everyone, which is incredibly hard. So I think the other part of that defensibility equation is actually around distribution, right? So this involves things like where are your channels to market, what is your distribution strategy, and how do you capture superior margins? And this basically is like building a war chest, right? It's a way to stay ahead of the competition. I mean, in our case, as an API marketplace, the business had a few interesting characteristics. The first one is that basically our buyer and seller persona are largely alike. I really can't think of any marketplace model today where this exists. The second thing is that APIs are actually like quite sticky. So compared to SaaS, like the churn rates are much lower because it's code based. And the third thing is that because we were a platform play, we end up becoming the de facto place when a developer is looking for an API after they find the first one, right? So and that thing ends up creating like additional lock-in effects, and that is how, in my view, it feeds into the distribution defensibility part of it. And this is how I think I look at this this question.
Right. So it's all about how the startup creates a defensive mode in terms of not only usability, but also the UX and the distribution channels they're using, and how the strategy for them to stay on top of the game. So that
absolutely,
we would look as an investor to startups that are using the similar business model.
Yeah, I think absolutely. I think in the same vein, I'm personally like bullish on the growth of API companies. I think we're the very early stages of this boom, right? Where there's a common scaling playbook for these early stage companies, and if they're successful, they can generate a lot of like sticky revenue that grows alongside their customers. So in this way, an API company can also become a platform play by itself.
Right. Along this line, then, talking about how investors would look at startups, Question for you, Ben, would be you have invested and also been in advisory roles of a lot of startups in your investment life. And you have also your fair share of startups that have exited. What would you think is the common X factor you find in the teams that have exited?
Yeah, it's an interesting one because it's all about team, right? Because the worst idea in the world, you put a good team onto it, and they'll pivot and do something good. The best idea in the world with a terrible team is still not gonna happen. So it is all about team, and there's just a sixth sense you get, and it's the same as anyone. Like I guess when you're dating, you just get that sixth sense that person that you just is just right for you. It's kind of the same thing with startups. You just find the founder who is professional but can take guidance, who is confident but not arrogant, who can sell but can also partner, just someone who's really balanced. And I think the interesting thing is that, if you think about, we've all spent time in networking events and meeting with people, and you have those people that are on one side or the other of those different spectrums. And it's kind of sad because you see that person who's just awesome, who's just really got the hustle and could really sell, but doesn't have the self-awareness to know that selling is actually about partnering. Or you see the person who has a real technical ability, but can't relate to staff. So it's about finding someone who's balanced and can just execute. And I mean, I'd say all that, but then I'd also say, if I think about all of the exits that I've been involved with, all of them had a significant amount of luck. The reality is that everyone starts their business, and you see all these pitch decks, and you see all these things. It's like, these are our acquirers. Well, it doesn't work that way, because those acquirers might not want to buy you. They might not be in a position to buy you. They might not. It just happens. And a lot of the exits that I've been involved with, no one's even known who the acquirer was. They just kind of turned up, and no one was sure why they wanted to buy us, but fine, that's all good. And I think the thing, I guess it's related to my sort of growth hacking or antithesis of growth hacking thing, is that there's all these myths in the angel investing and in the VC space. It's like, here's the formula, here's our acquirer, we know what's going to happen, we know what the multiple is going to be, it's all easy. And that's bullshit. Like, it doesn't work like that. And I think it's really, I feel bad about it, because I see new angel investors coming in, hearing all that stuff, and thinking that it's just easy. If it was that easy, everyone would be doing it. It's not that easy, and it's not that guaranteed. Yeah, I've had 10 exits, but I've also had more than 10 companies that have gone bust. So, like, if I had all the answers, or even any of the answers, then all of my exits would have been good. So I think it's really important. I think that angel investors have a bit of a moral obligation to actually be quite honest about that stuff, because otherwise it kind of becomes a bit of a Ponzi scheme, and it's only when you invest that you realize that it's not quite as good as you were sold.
It's very important to build the trust between the investors and the founders. It's not only about finding the founder charismatic. It's also about building a relationship between a very transparent and trustful relationship early on.
Because it's going to be years. I mean, the reality is that most companies, 5-7 years is kind of normal to some kind of result. And so it's long term. I mean, that's longer than most marriages last these days. So you really need to be thinking about, as you say, you're absolutely right, Jowell, like the relationship that you have with the founder and the team.
Right. Okay. So that was a very great sharing. And we only have a few minutes left to the panel. And I'm very sure that a lot of our audiences would be very curious about how to get into angel investing. So, what would be your advice for people who are looking into venturing into the amazing space of angel investing? Why don't Jet, you start?
Yeah, so I think that I'll just reiterate on the things that I've already mentioned, right? The first one is around starting out with a focused thesis. You can always expand it later, but it's hard to like scope down. Um, so be clear on like the geography, domain, and stage, and have a clear rationale for yourself of why. The second thing is, as I've already said, take advantage of syndicates, right? You are learning on this process, you are hedging your bets, and you're managing your downside risk. Um, and just a final point on general advice, and this is like touching on what Ben has already said. Um, be very honest with yourself about the downsides of angel investing, right? Yes, you are playing for asymmetric upside and multiples type returns, but what you are also exposed to is completely losing your investment. You have illiquidity to deal with in this asset class. Um, so be aware of like the risk before venturing in.
Absolutely. A lot of people are, it's a big word, venture capital, angel investing. It seems like the cool thing to do, but before venturing into these spaces, we have to understand the risks that are involved. It's not all about investing into the next Facebook or the next Google, but it's also about we have to know that you can lose all your money that you've invested. So it's very important to know what you're getting into. How about Ben?
Yeah, I think I'm going to use my marriage metaphor again. Most people wouldn't get married without dating a person and kind of finding out what they're like. And it's the same thing with angel investing. Spend time around startups, go and mentor at an incubator, do some advisory work, read some blog posts, just kind of swim in the waters and see if it's for you. Because there's a lot of people who it's totally not for. They're risk averse. They want to be in control. They don't have any knowledge, and that's totally fine. Not everyone should be an angel investor. So totally, just get out there, swim around the sea, have a look at some different things, meet some people, and just see if it's right for you. And then when you do it, and do your first few in a low risk manner. Syndicates are really good for that. I personally, I'm lucky that I've always been able to direct invest just because of my situation, but syndicates are really good if you're starting out, you don't have a lot of knowledge and you don't have network. So small sums through a syndicate and suck up all of that knowledge. You're doing an apprenticeship, so just be serious about it.
Awesome. Okay. Well, that was a very fruitful discussion. Thank you it was an honor to be chatting with two very experienced angel investors.
Please virtually give some hand claps to our panelists. We're actually quite fortunate that Ben has stayed on to answer any of your questions, and we see a couple streaming in from Lark and also from Zoom. Hi, Ben.
Hey, man. How you doing?
Good, thanks. By the way, where are you calling from right now?
I'm at home in New Zealand.
All right, that's fantastic. Well, it's great that we can catch you at this virtual conference. Good that we could catch you virtual, right? Right, so a few questions that are being directed to you. Hope you don't mind answering them for us. Ben, when you're selecting startups to invest in, is sustainability or impact a key factor in your decision making?
Yeah, for sure. I'm involved. I'm a director on an organisation that's all around fostering social enterprise in New Zealand. So I've got a real passion and interest in social enterprise, and so absolutely the whole focus on social, environmental, as well as financial returns is really important for sure.
Yeah. In the context of the global pandemic, do you see any of these deals that were previously kind of trudging along now get accelerated because of, the impact of COVID-19 and the
Yeah, I've
potential
seen a bunch of stuff.
opportunities?
Yeah, I've seen a bunch of platforms around sort of mental health around lockdown,
Right.
kind of opportunities like that that absolutely have sort of an impact angle to them, have got a bit of momentum at this time.
That's fantastic. Another question from Alvin. Also, which investment was the most unforgettable for you and why? I think this is a very personal one for angel investors, right? I mean, we were talking earlier about the best ones may not be the sexiest.
Yeah, I mean, I think one I was that was really fun, or that was really cool for me was Publons, which is a sort of an academic peer review platform, and I met the guys when they were in an incubator, pre-product, obviously pre-revenue, and myself and one of the angel investors that I most respect did a little bit of a bridging round, like tiny, a few $1,000s,
Right.
and then invested and rode the wave, and they exited to a big listed company a couple of years ago. So kind of those ones where you get in really, really early, and then eventually at the end you kind of validate it.
It's fantastic. What are your key learnings for the ones that actually failed? Because it's super high risk, of course.
Yeah, it's all about people. And so the ones that have failed, when they fail because of something that isn't their fault, it's sad, but you can deal with it. But then there's been the 3 or 4 or 5 where people have just behaved badly, and that
Right.
sucks. Yeah, that sucks.
So, okay, so trust with the founders, their behavior, and basically whether they're good, sensible human beings with, very good business judgment is always your number one.
Totally. Yep.
Okay, I've got a few more questions here. This is quite general, and everybody's asking, what's the next big trend or sectors?
So anyone who tells you they know what that is a snake oil merchant. No one knows. Obviously, crypto in some form is going to be big. Bio is big. Quantum is big, but who knows?
That's fantastic. Ben, do you have any final advice or, let's say, words of wisdom for any entrepreneurs who are just starting out on their journey right now? And these are very uncertain times. We don't really know how this, pandemic is going to last longer for. Some of them have already committed a lot of their funds. They're frozen, or, they're being discouraged with things not moving. Any words of advice for them?
Yeah, talk often and talk early. So to your investors, your employees, your customers, your suppliers, all your stakeholders, just communicate, because relationships will get you through when things are bad. And if you don't have that good relationship, then you've got a problem.
Good. Don't keep it all in. All right, Ben, we'll let you go. Thank you so much for joining us here at the Startup Impact Summit Venture Stage. For all of those who are just tuning in or who've seen the entire session, all of our panelists are available, and you can reach them and ask questions here on Lark or at Zoom, or if something comes to your mind later on, send it over to us and we'll be happy to drop them an email for them to answer you later on the next couple of days.